Markets around the world are crashing in front of our eyes, but as we enter into corrective territory for stock markets such as the Nasdaq, we've got the stats that tend to happen next. What about 1 week to months after? Do we see positive or negative results moving forward? Also, this earnings season, are we actually beating expectations, or is this all about forward guidance? Today, we discuss some of the biggest bear commentaries right now in the markets, and also we talk about the key zone that we've finally hit. Yes, we reached the most traded zone of the last 18 months, and we know this is Wall Street's favorite level. So what will happen here could dictate everything about the next couple of months, and we'll break down where the percentage of stocks are right now, semiconductors, and how important this chart is, and of course, the most important semi of all, will the head and shoulders start to break out? This could be the most talked about chart on the internet right now. Join us as we cover stocks, commodities, and cryptos together. Well, welcome back, everybody, to The Daily Show, where we talk about markets around the world, including the macro lead indicators and the hottest charts. It was a red session across the board, mostly led by technology stocks. And many tech traders will be looking at this saying, oh, maybe I want to start looking at the investment cycles. We'll talk about that more soon, but Fear and Greed Index dropped into 26. Now, I'm interested in seeing the BOFA report this weekend because I noticed that we almost are on an extreme buy, and I'll be updating on this channel, so make sure to set the alerts and, of course, subscribe when that does occur. That indicator tends to be a pretty good one. It's getting closer and closer by the day. In terms of earnings beat data this earnings season, we're at 71% beats, 520 versus 216, and I would say that's actually pretty good. It just shows you, though, the forward guidance is the key. In this tough environment, the market is looking for a little bit more. But as we enter into correction territory, I want to talk about some statistics. What happens next and how often does this occur? Here's a great chart here from Charlie Bilio, and basically it shows how often we see correction style markets. That's usually negative 10%. 63% of the time we see it, and it happens on average every 1.6 years. Notice, though, that it gets way less statistical as you drop under something like 20%, only every 4 years, 5 years, 9 years. And if you're wanting a 50% drop, it only happens 2% of the time on average every 47 years during a calendar year. So it just shows you the statistics might be a little bit different to what you think when it comes to fear. So when we enter into correction territory, which we did about a day ago, what happens next? 2 weeks, 3 weeks, and even 1 month later, sometimes we are a little negative. But the average statistic would show you that the next 3 months, 6 months are actually a little bit more positive. And we've got some pre-election data that we've broken down later on today's show that might interest you, along with some key charts. Let's also talk about what's going on with yields. We're seeing a big drop-off in yields as we go into this correction territory and Wall Street's most traded zone. And by the way, there's a big transaction that went through on the equal weight, which we'll talk about soon. But this was a fairly steep turnoff in terms of how much lower it's gone. And I think that's because the market's now saying, well, guess what? You broke something, Fed. You're going to have to cut a little bit more aggressively now in 2024 than you were about a week ago. Things are starting to look a little bit nasty. So how can we turn up? How can we see the bulls re-enter back into the market? Well, for the bears, this is a good sign. We'll talk about sentiment first. On the CFD side, that is basically the leverage contracts throughout everywhere there is in the US, we'll just call it futures market for the US, then we're seeing basically most retail traders remain bullish in this market. 67% of retail positions currently opened are bullish on the S&P. Dow 65, UK 76, and the DAX 63. We're wanting to see these reduce, and I'll update you on the channel as we see sentiment switches in this particular thing. And of course, we'll put it on over on our X account, our Twitter account, links in the description down below. We've finally got the new sentiment report, and we kind of guessed this would happen. And this is a good sign for the bulls and a good sign for structure to potentially be created down here in this key Wall Street level. 43% of participants went negative on the markets over this last week. 27.5 went neutral, and of course 29.3 are bullish. Now, this is a little bit contradictory to the sentiment indicator we were just talking about before in terms of CFD opens. So what we're looking for is usually a wipeout. That is a market that comes down, takes out those positions, starts pushing back up, and everyone starts to get convinced of a short. We're looking for that sign. We will be paying attention to it. Bull bear spread, that declined again back down to -10, which we kind of expected. And this is usually a time where, say, somebody that's looking at positioning in or a positional investor or something is going to look at this market very closely. Here's the breadth of the XLP. So we're actually starting to see a pretty interesting sign for this. Now, everyone has hated this particular sector recently. Staples have been doing pretty badly. Here's a great stat though. Basically, we have a 100% positive style average return almost for the year. 92% win rate a year later on XLP in similar situations of breadth change. And this is kind of what happens after 1, 2, 3 weeks, etc., and whatever happens over 6 months. So look, it's not the best return, but it's showing you that something like Staples could be coming back to a key level. And it comes along with the idea that corporate insiders are actually starting to heavily buy XLP at these levels. Now, they've been buying for a little while, and you can see that there are certain times when they choose to pull the trigger, and it tends to be relatively okay. That's why those stats over the next year tend to be inside. Corporate insiders, they're not selling their positions. They're going, you know what? I'm feeling pretty good about the world and things are looking okay. Let's talk about forward PE now when it comes to the markets. Now, this is probably sitting at about 17.1 in terms of the new update. 16.8 forward PE is the average over time. Now, a few of you said, I'm not buying till it hits 15. Fair enough. You have to have your own reasons. And of course, it's just one statistic. But for dollar cost average position buyers, they often look at a statistic like this along with some other reasons and say, you know what, it's coming into a zone that I like technically, and possibly I like also what I see in terms of the forward earnings. That, of course, needs to be backed up with actual earnings, but we have to expect some of these boffins get it correct. Another good sign for the bulls is obviously to see the bullish percent index so low. At the time of this update, I think it's sitting about 25, so it's dropped again. If it gets into the 15, that will be an extreme low. And obviously, we're expecting that if we hit a 15, we're in a capitulation sell. So that's going to be a really good point for market participants if they're looking at trying to buy the dip or buy the bottom. We're not there yet, but we are at a very key zone that we're looking for structure. Another one is this statistic, which of course has to do with when we see uninversion of the yields, the US 2 versus 10-year. Has that happened yet? No, and we'll show you how to see that later on the charts in today's video. But remember, when this tends to occur, we actually move into usually a rallying market followed by a bit of a horror show. So one thing's for sure is 2024 is going to be fireworks on the market. So make sure to subscribe to this channel because we cover it daily here on the show. Now, everything else, just a reminder, follow us over on the Twitter/X platform if you're interested in more of this stuff. But let's talk about Bitcoin here. A lot of people still asking, what do I think about it? There are quite a few things I'd like to deep dive into in a video moving forward, but I've always believed in the halving cycle. I think this is a good period of time for Bitcoin generally, and I'm really more looking towards what happens into the actual halving itself. Will we get that kind of fall off that happened last time? And then strength, I'm pretty positive on 2024 from this pair. I also posted over here the kind of concept of what Bitcoin's done over its 13-year history. And you can see you had some massive percentages at the beginning. You have to start getting used to less percentages. You're not going to see a 1,330% gain from like 2017. You're not probably even going to see 300% gain like 2020. 2024, it may be in the vicinity of 50 to 100, who knows? But statistically, as you can see, it starts getting less and less percentage as the market becomes more of a sustained market that's been around, kind of like a more regulated market with exchange traded funds starting to come into it, a lot of options, a lot of different synthetic instruments. Basically, Wall Street's in this now, so you're not going to see those types of gains again. But it is positive for the cycle for, of course, 2024. Let's talk about pre-elections, though. Where are we? Well, it's a little bit different to some pre-election years, but you can see here, first-term election presidents, all pre-election years, which tend to be negative into the back of October, and then, of course, what happens after a midterm bear year. So some great stats here. And again, you'll notice that we often do see sells into the back of October. November's really the tester for most of these markets. November, but more importantly, look at this actual real Santa rally. So the Santa rally tends to actually happen after Christmas, and then you say to the new year is the traditional Santa rally. But these December periods are phenomenal in these types of years. So I think the lower this goes, then the better structure we get. there could be some great positives moving forward. Let's also talk about what's happened in most years, 15-3 in similar statistical years. We do have a little bit of data here, so I'd say it's relatively good. And of course, Wayne over here will constantly update it, and I'll bring it to you when necessary. Let's also look at gold. Gold has been a top performer. We first alerted this when we found out how many shorts were open in the market. We saw that big Friday trade, and of course, this has led into already a pretty good gain. Overall, gold still looking good. I'm going to keep this chart on for a while just because I think it's a great reminder of a very pivotal piece of information that we don't often get in markets such as this. Let's move over now, though, to dark pool transactions, and this is where it gets really interesting. Number 2, a big one that's coming in the equal weighted market, which we'll look at later on in today's video. This level is key. An equal weight market is super important. This is a huge transaction, and you've got to hope that these guys know what they're doing. This could start to form a base on this market and basically say that maybe breadth is going to start coming back. We also saw some phantom prints coming in for the SPY at prices that didn't really even exist, which basically means that we're starting to see some transactions come back in. Maybe there's support here in the markets around this level. We do know it's Wall Street's favorite zone. Let's move over to options now. What happened in the options world? Lots of transactions, but interestingly, similar to that sentiment we were talking about before, even though we got 44 million or 44.6, like a huge amount of options compared to 39, we're still seeing lots and lots of calls in comparison to puts. I would usually want to see more puts started to float through into the markets. That's not happening yet. Here are all the unusual ones. I think the one that isn't here, or it is here down here in end phase, this was a disaster after hours. My goodness, this thing got smashed another like 15% or something. It's a great recognize. I think you should actually go and have a look at something like this just to recognize why sometimes buy the dip strategy is an absolute nightmare. Here on the channel, we like to buy the V. We like to buy the turn. That's something that we're really going to talk about a lot. Structure, creation of the market, replication. These are the things we look for. And it's not about, recognizing, oh, this trend's going to go here now. It's about saying, how much risk do I need to take to make that reward? In this case, there's so many different options going off in the last 24 hours. You can have a look here at the chart and go and check out some of the things that you might want to. But again, it was just a stacking of puts across things such as the Russell 2000, etc., which we'll discuss soon. What about the last 5 days? It's basically been the two defensives doing well. XLP's almost eked out a profit now. We saw insiders buying that, obviously, and utilities 2% up. So the solar technology, they were the ones that were actually accelerating down. In particular, tech and communications, they were actually showing really bad sessions. Down, down, down. Prices are down in this case. And it shows you that basically we're in a market now which is being led to sell by the biggest tech stocks. Now, as long as that continues, we're probably in a bearish sentiment. If we start to see the most tasty gamma style stocks pick back up, that's going to be a turning point as well for structure. So the longer these tech stocks come down, firstly, the cheaper the prices a lot of us get. They are warranted potentially to come down, I think. And then once they start to turn back up, that's when you'll really be paying attention, along with some lead indicators we'll discuss in a moment. In terms of percentage of stocks above the 200, that's down to 25. We're not into the under 20 territory yet, but actually we saw some little gains, even though you might think, oh, today was a terrible day in the markets. It was for tech, but notice this, it wasn't for some of the other ones. In fact, look at the percentage of stocks above the 20. It actually increased and it's been stabilizing. So some of the breadth in the market is improving. US 2-year versus 10-year, this chart is very important. We need to watch this. We saw yields basically stay, let's call it standardized. TLT did do a little bit better. It wasn't really a bad day for yields, but we're not underneath that 1% yet. So we haven't uninverted just yet. We don't know. Again, that could be a catalyst for us to see a turn. Have treasuries bottomed? Well, Ackman obviously thinks they have, but really nice resurgence here in strength. And I'm pretty happy to see something like that start to appear here on the treasuries. It looks like a great zone. If you go out to the weekly, obviously this is just like incredible stuff where we're at. It's multi-decade lows, but we'll find out whether it can hold. So far, signs are good. Copper holding up as well. Dr. Copper doesn't seem to think that the world is as bad as everybody else thinks. So are the doctors correct? Well, at this stage, we're watching the price action. We're looking for a breakout of this trend line to show us that maybe there's some strength back in this economy. Now, we talked about equal weighted market averages. Now, have a look at this volume. Boom. That's a big volume, guys. There was another big one like this over here, but that's huge. Some transaction came in here. Obviously, the day ended negative, but now we can scroll into the 2 hour and we can start to say, well, let's set some alerts. I've set one here just below 138, and I know we're lower than that at this stage, but if we get through here, considering the massive trade that's gone on through here, I'd be feeling a little bit more smiley face. Now, at the moment, bears, don't worry, you're in control. There's no doubt. Bears, you can dance around. It's all good for now, although I think we hit a massive TP zone on the markets from a technical perspective, but that was a big deal. Have we seen injections back from the markets yet? No, the Fed and both the world central banks have not injected back into the market. Interesting stuff. Dow Jones Transportation Average looks horrible still, showing us that the economy could be slowing. Again, this is a lead often considered. Have we got basing? We don't know. Are we in the zone that we like? The answer is yes, we are. So we're looking for the signs. Remember, buy the dip, not really the greatest philosophy if you want to save money sometimes. It's buy the, let's say, levels if you're using an investment philosophy. Remember, we don't really want to be trade investors here. It's not really the ideal way of investing. Let's talk about home builders. They've still been suffering, although it did start to slow down. And just before we go to the next chart, let me just show you here end phase, just so I can show you. Now, this is down 17.37% to 79.47 after the bell. Now, we've had a go at end phase a few times as a trade, as it's dropped back down and created some support. Some have been profitable, some haven't. I would say it's about 50% actually. However, because we made more than 1-to-1 ratio on it, it's actually been a profitable trade at the right levels. The only reason you're not down in a position like this is because you've been waiting for structure to create. And there has been a couple of decent little trades through some of these levels. The most notable one, though, recently was actually a negative. So it just shows you again, this market is very, very volatile. This stock has gone from $325 down to $79, and that's all happened mostly through 2023. Will it eventually bottom? Sure, but you could have said last 24 hours, what do I think it's going to do? I would have said, well, it's been selling off into earnings. There's a good chance it might pick back up, but it sold off massive, 17.37. It just shows you that you have to expect the unexpected and control your risk. So if you were trading this, you shouldn't really lose too much because, of course, you would have controlled your risk ideally. Let's move over to the US dollar, still neutral throughout here. Some people will be arguing with me and saying this is a double bottom, Tom, inside of the creation. Fair enough, but we didn't really see exactly a huge amount of strength yet. I'm still going with the neutral tab on dollar until we see a breakout. We're looking whether this is distribution or accumulation. If it's accumulation, big times ahead 110. If it's distribution, we'll talk about it when it occurs. Gold. Yeah, again, this is also trying to stop the freight train. Here you can see the big supply, big level for it. I would like gold to do this personally, but at this stage, it's just doing its own thing. It's creating in here. We had a short, broke even that short, or possibly even took a 2-to-1, depending on how you wanted to trade that particular position. But at this stage, I can see it kind of hovering here for a little while as it regains some of the indicators. Gold stocks, decent little bounce coming back after losing maybe 2% actually through the day. We saw some pickup. This was clearly a resistance or sell zone. We've pulled back a little bit, which is a good sign. And now I'd be looking for ideally gold to start coming forward. Not too many great technicals here, but you see the volume did improve on the session. So that's just GDX. US oil, it continued to kind of fall. However, it has tried its best. This was the level we talked about, could have a short on it. If we now see some type of market condition where it takes this and then it moves forward, that's going to be bullish for oil. But at this stage, we're looking towards the negative side. So obviously, oil is still in a downtrend until proven otherwise on most of the shorter time frames. Let's now move over to a few of the other stocks. Now, Apple was one that I was a little bit more bullish on, which you can see here was the 200 daily. I like this level. I cautioned against it moving through here as being the big catalyst, and this area here being more of a speculation. This is again maybe why it has, a lot of patience and reacting is better than predicting. Did I expect Apple at this point? Probably not, based on this overall creation. However, this is the difference between someone that is scaling in, potentially reacting to the market, and not. Apple with a new low, not necessarily a great sign. You can see it closing underneath here, at least on the daily. So it could keep falling, and that's the problem. Is this market being led by tech? Are tech going to be picked up? We like the US 500 level, and we'll talk about that soon. Tesla, bring it back onto the charts. I know a few of you are complaining about this one and saying, where's Tesla? Where's Tesla? Look, the thing was there were so many other stocks to trade and look at. Tesla, there's nothing much for us here. We know 200, well, more importantly, I think 180 is a key critical zone for Tesla. It's kind of in the nowhere zone. Has it made structure? Not really. Has it done anything in particular that makes us really excited about it? Not really. Will we update? Absolutely. So we'll keep focused on that. Trend is still down for now. Okay, that's how we're looking at it. NVIDIA, let's bring this one up. So I had a look through the ratios. Now, NVIDIA's trading, I think, about a 29 forward PE at the moment. On average, it's actually traded like a 40 to 46. So quite a lot higher than it is right now. So on paper, it looks good. The problem is forward earnings growth compared to the price doesn't seem to be that positive, like the peg. So I think this thing is interesting. I would like to see it at an under 25 forward PE for it to be getting cheap. So here's the head and shoulders that everyone's discussing. Obviously, NVIDIA put in a monster level, and this is so important. I'm going to set an alert because I would say if we take this high again in the future, we're looking quite positive for the market. So I'm going to set an alert above there. I think this level is super important. Most people are discussing this. So if it does come through and ends up filling, it is a proven level to fill to 300. And we have warned against NVIDIA for quite some time, saying that it's in sideways to down action. And that's because it had such a massive rally. It's got to take a rest. And NVIDIA loves doing this type of thing. I'm wondering, is there a trap here? So let me know in the comments down below. Do you think there's a trap in NVIDIA? It's the head and shoulders that everybody sees. It looks like textbook. It proves beautifully. It's a critical zone. Buyers need to come into that over the next 24 hours to support it, or we need to see some kind of trap, which we'll be watching to react off. Let's now look at the US 2000 and check out what's going on there. And of course, we see a market coming down to key levels and mostly finding some buying pressure. So you can see here a little bit of structural pickup over the last 24 hours. Let's have a look at the small time frames. While the rest of the market was selling, there was rotation into the small caps. Enough for us to get excited about? Quite simply, no. We didn't really see a huge bounce or anything like that. It was very small time frame stuff. We'll be watching this, maybe one of the most important charts to have on your list at this stage. The Aussie 200 actually held pretty well considering everything that's going on in the world, and that's thanks to copper probably holding up a bit. The German 40, again, we thought this one might hold a little bit better. It is for now. We'll see whether it can hold those lows. CQQQ holding okay, I guess. And then we move over to the Qs. So the Qs broke down the trend line. Now, they're not quite at these gap fills, but remember these? Look how many gap fills there were. I wonder if this is full capitulation. Imagine if it was. Boom, 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 boom. Finally get all these ridiculous gap fills that we've had for ages filled up. I'm not sure we're in that type of territory yet, but of course it has broken through a key zone. The S&P holds, I believe, the biggest key here. And we can see on the futures as they open back up, we've got a little bit of a gap back up. So it's taken this low, 14,200. It's in the middle of nowhere land. Some people will argue that it should get down to like a 14K at least before possibly resuming. I would say there's nothing much looking positive here on the NASDAQ. The NASDAQ is super hard to read because you just say bearish, bearish, bearish at this stage. Maybe you need to get it back above these yellow lines to make it, feel positive because it's actually put in a low, maybe a trap. But I like the S&P. This is Wall Street's biggest zone. This is the zone that they have traded so consecutively for 18 months. They're probably going to look for some structural defense here. Now, we don't know exactly how they're going to defend it. At this stage, we just know this is obviously a key zone. And 41.50, 41.20 has been a level we've spoken about for like 6 months. So patience is paid here in terms of getting it back to the price, although the way it's gotten here is different because, of course, we have tech still much higher than it was last time when we broke out. So tech, if it's going to sell, would be the one that actually needs to come back down to earth. A good way of looking at it would be like, say, put the Qs versus SPX. And on the chart, what this will do is it'll show you how much the Qs have been outperforming the S&P 500. You can see this huge outperformance. Maybe it's time to see some rotation where the S&P does better than the Qs due to it just being way more oversold. or maybe it just shows you how bad the economy really is underneath the hood. Let's have a look at the US 500 futures, back down to the trend line, near our green line here, which is pretty important. This is a big level for us. And of course, we know the most traded zone. So we're looking for structure. Let's go to the 15-minute chart and understand how the market's traded so far. So you can see it came in here, hit the 41.50, had a little bit of a bounce off that most traded zone. Boom, there we go. And then just went boom, straight back down. So we can kind of guess that this area here is our supply at this stage. We know we've got a new low. We know that if we take these highs from the previous sell, that's going to be boom time. So that's going to be really great. But in terms of this structure down here, we're probably looking at a 4180 to 4200 breakout. If that does occur, we're starting to get bullish again on structure. For now, trends is down. Bears are in control, and dollar cost averages are probably looking at this saying, wow, we're almost at average PE forward. That's pretty nice. So key level, big zone. If we do take this area, a few people have asked what happens next. Well, it could get kind of brutal. I would say down to this level here, which is around 40.50, is pretty normal. So anything in here to create structure is fine, I think. If it starts to go underneath this level, we're in capitulation. Then you're going to see flash crashing, I believe, and it could get as bad as like a 38.50. To get under that, I don't know. Statistically, probably unlikely based on the time of year, the type of year as well, everything else. It seems likely that around here is where we're going to form a structure. But, a real bear would be like, down here, or even some of you are probably 3,200. We're going to see how this trades out first. I would like to see further structure creation and obviously find out whether Wall Street want to defend their zone. Let's talk about everything moving forward in terms of news. We've got a little bit of news coming out. Basically, core PCE price index and revised UOM consumer sentiment is the big deal here. Make sure to stay on top of the news for the next week. You can do so by subscribing to this channel. Links in the description down below, of course. And make sure to follow us over on Twitter, X, all of that good stuff. Thank you so much for supporting the channel, guys. Give it a thumbs up if you enjoyed today's video. Be careful out there. Risk management is key right now, and obviously looking at it as much as you can from both sides. If your thesis is bullish, let's look at the bear position sides that we've talked about today. If your thesis is bearish, let's have a look when the signals go bullish, and then, of course, recognize those. Thank you, and bye.